Imagine waking up one day and knowing you have a steady stream of income coming in each month without lifting a finger. Sounds like a dream, right? But it doesn't have to be. Stick around for updates on our upcoming giveaway. In today's video, we're diving deep into how you can create that reality with smart investments that generate income on autopilot. I'm not talking about risky stock picks or betting on the next big thing. I'm talking about a powerful tool that's surprisingly accessible to all of us, no matter where you are in life. Whether you're just starting out with a small budget, planning for retirement, or somewhere in between, there's a strategy here for you. Stick with me, and by the end of this video, you'll know 3 proven strategies that can help turn your money into a long-term income machine. I'll show you how much you need to start and how to grow it step by step, and exactly how to set up a plan to reach your financial goals. So if you're ready to take control of your financial future and unlock the path to financial freedom, let's dive in. What is an ETF anyway? To start, let's get clear on what an ETF or exchange traded fund really is. Think of an ETF as a bundle of different investments, like stocks or bonds, all wrapped up together. These bundles trade on the stock market just like individual stocks do. ETFs let you invest in a whole mix of companies without having to pick each one yourself, which can make investing simpler and less risky. Now, dividend ETFs go a step further. These funds focus on companies that pay out dividends, which are regular payments made to investors. So with a dividend ETF, you're investing in companies that aim to share a bit of their profits with you. This way you get the potential to earn both from the stock's growth and from those dividend payments. Let's talk about the Schwab US Dividend Equity ETF. The Schwab US Dividend Equity ETF, or SED, is a big name in this space, holding over $52 billion in assets. Launched in 2011, SCHD focuses on strong US companies known for their steady growth and reliability. What makes SCHD unique? It doesn't rely on daily choices from managers. Instead, it follows a set formula to choose companies with solid and growing dividends. This hands-off approach keeps it consistent and focused on companies that already have a track record of paying reliable dividends. With SCHD, you're getting an investment that doesn't put all your money in one place. Instead, it spreads it across many companies, reducing the risk tied to any single one. Over time, the portfolio adjusts itself based on its preset formula, aiming to keep it balanced and growing. So, if you're curious about building a financial future with income you can count on, SCHD and strategies like this could be a great place to start. Trusting the SCHD strategy. For investors, choosing SCHD means trusting Schwab's unique approach. Here's how it works. Schwab focuses on dividend-paying companies from the Dow Jones US Dividend 100 Index, but SCHD has strict standards. It doesn't just pick any company. It looks for firms that have a history of growing dividends. These are companies that have been paying out dividends for at least 10 years, have a market value over $500 million, manageable debt compared to earnings, and stable profits. SCHD also spreads out its investments wisely. No single company makes up more than 4% of the fund, and it keeps a balance across industries to avoid putting too much weight on one sector, like tech or healthcare. Schwab's approach centers around finding companies that are likely to keep paying dividends for the long haul, showing their commitment to stability and steady returns. Now, some people worry about SCHD's hands-off approach since there's no active manager making daily decisions. But this strategy is designed to ride through market ups and downs, aiming to create steady growth in dividend income over time. How has SCHD been doing? Looking at SCHD's performance over recent years, it's been a bit of a mixed bag, especially compared to the S&P 500. It faced challenges during the pandemic, and it didn't quite keep up with the S&P 500 over the last 5 years. But here's the thing, this might actually be a good time for investors to join in at a lower entry point. Even though SCHD hasn't always matched the S&P 500, it still aims to reflect the total return of the Dow Jones US Dividend 100 Index, staying focused on stable, long-term returns with low fees. One bright spot, SCHD has shown resilience in tough times. After hitting a low last October, it bounced back with a solid 4.3% rebound, showing its potential for growth. This kind of comeback hints at the strength and potential of SCHD for those thinking about the long game. So, If you're looking for steady income, balance, and a strategy focused on long-term growth, SCHD might be worth a look. Should you invest in SCHD now? When thinking about SCHD as an investment, it's smart to consider what kind of income it might bring in and the current market conditions. Right now, SCHD offers a forward yield of 3.5%, which means that's what investors could expect to earn based on today's prices. But here's a twist. With inflation on the rise, US Treasury bonds are offering higher yields. Because of this, some investors might hold off on SCHD, waiting for its yield to improve before jumping in. But hang tight. Coming up, we're diving into 3 smart strategies that could help you get the most out of SCHD without needing a huge upfront investment. These strategies are designed to give practical tips for making money in a market that's constantly changing. If you have watched to this level, kindly hit subscribe, like, and leave this video a comment. Why dividend yield matters for SCHD investors. For anyone looking to build steady income, understanding dividend yield is key. This yield shows the portion of dividends you'd earn compared to the stock's price. SCHD regularly updates its portfolio, which means the dividend yield can shift based on which stocks are added or removed. For example, in its latest update, SCHD made some big changes. It removed stocks like Broadcom and Federal Agricultural Mortgage Corporation, companies that, while growing in dividends, didn't meet SCHD's strict standards for long-term financial health. To keep the portfolio strong, SCHD made room for 23 new stocks, including Cincinnati Financial Corporation and Bristol Myers Squibb, both of which show strong dividend potential. Some may wonder about the short-term performance of these new stocks, but SCHD's focus is on the long run. By sticking to a formula, SCHD aims to deliver steady returns over time, building a portfolio that could be a reliable source of income. So, if you're looking for a dependable way to grow income over the long term, SCHD offers a balanced, disciplined approach, giving you a steady path to financial growth. InvestED is here to make your holiday season extra special. We're hosting a holiday giveaway exclusively for our subscribers who actively engage with our videos from now until the 3rd week of December 2024. Don't miss your chance to win. Just stay subscribed, like, and interact with our content for a chance to celebrate with us. Making the most of SCHD's dividend yield. Understanding and keeping an eye on dividend yield can help investors make smart choices for steady income. Now, let's dive into SCHD's current yield and see why it could be a solid pick for those looking for long-term growth. Right now, SCHD's dividend yield sits at 3.5%. Sure, this might not seem as high as what some other options offer, like business development companies or REITs, real estate investment trusts. But there's more to the story. The true value of SCHD lies in its consistent dividend growth. Over the last decade, SCHD has delivered an impressive average return of 10.87% per year. That kind of growth makes SCHD popular with investors who want a reliable income source that grows over time. SCHD's strong record of paying dividends for 12 years makes it trustworthy for income-seeking investors. Plus, these dividends are often tax-friendly, which can be a nice bonus for building wealth steadily. Just imagine, if you had put $110,000 into SCHD back in 2012, you'd be earning over $1,400 in dividend income each year today. That's the power of sticking with a well-thought-out income plan. But before jumping in, it's essential to think about your own needs and goals. While SCHD's steady growth is great for long-term wealth building, it may not be the best fit for those who need higher income right now. If you're close to retirement or need income fast, a 3.5% yield might not cover your immediate needs. In that case, options with higher starting yields could be a better fit, especially if you don't have time to wait for dividends to add up. Ultimately, by carefully looking at SCHD's dividend yield and thinking about what you need for your financial future, you can make a decision that supports your income goals. Investment strategies for every investor. Like I promised, here are 3 strategies to help you get started with both short-term and long-term investments. I'll also show you the lowest amount of money you'd need for each. Let's dive in. Why SCHD? SCHD offers a great path for building wealth over time with a focus on growing dividends. Even though its current yield is 3.5%, it has the potential to increase over time. making it a solid pick for those looking to build income in the long run. Whether you're just starting out or planning for retirement, SCHD can be an accessible way to begin investing, even for college students. Planning for the future, what you'll need for retirement. To know how much you'll need in retirement, let's look at what people typically spend. Right now, an average person in the US spends around $3,400 monthly, which totals about $40,800 a year on basics like housing, food, transportation, and healthcare. But here's the catch. Inflation. Over the past decade, inflation has averaged about 2.65% per year. So, if we look 30 years ahead, those monthly expenses could jump to around $7,000 or $84,000 yearly. That's why planning for future costs is so crucial. Strategy 1. Year 1 goal. The first strategy is all about getting started with the lowest investment needed to start receiving dividends right away. Here's how it works. Let's say you want to make $40,800 a year in dividends, or $3,400 a month. To figure out the amount you'd need to invest, just divide your goal by the current dividend yield of 3.5%. How to start receiving dividends with SCHD. To start earning dividends right away, you'd need to invest about $1,065,714 in SCHD. That investment would bring in $40,800 per year, or $3,400 a month in dividends, hitting the monthly income goal. But let's be real, that's a big number, and it may not be possible for everyone. So let's look at 2 more strategies that might suit different budgets and goals. Strategy 2, one-time investment for future retirement income. For our second strategy, let's focus on a one-time investment for retirement income. Imagine you're planning to retire in 30 years and want an income of $7,000 per month or $84,000 per year. Using a specialized calculator, we can project how much a single investment will grow over time with dividend reinvestments. For example, if John invests $25,000 in SCHD today, here's what happens. After 1 year, John's investment grows to $27,740. After 10 years, it's projected to triple, reaching $74,500. After 30 years, his investment could soar to around $1,819,000. This growth could yield an annual dividend of about $81,073 or $6,756 monthly by retirement. The stock's value alone could contribute over $1.15 million in growth, while reinvested dividends could add $533,000 over the years. Strategy 3. Monthly retirement investment for gradual growth. If the one-time investment isn't an option, here's a more manageable strategy. Monthly contributions. This approach lets you build wealth gradually over time. With $225 invested each month, about $2,700 a year, here's what could happen. After 1 year, your investment could reach $5,695. After 10 years, it might grow to around $54,900. After 30 years, your account could be worth $1,677,000. By then, this total could bring in around $84,458 per year, or $7,038 monthly in dividends. With steady monthly contributions, the ETF could provide a blend of stock growth, contributing $984,623, and reinvested dividends, adding $51,470. Take the next step towards financial security. Using ETFs like SCHD with a strategic plan can help you build a secure financial future. This is just the beginning. Stick around for more tips on growing your wealth, and check out our next video to see how you can turn your investments into a solid nest egg. Here's to your investing success. Profitable investing. The holidays are here, and so are the gifts. Subscribe to our channel, engage with our content, and you could be unwrapping a gift card soon.